Welcome to LearnBigBusiness.com, where we show you how to implement the latest strategies for your global business success. Please subscribe to our YouTube channel and subscribe to our website. Today we'll be concentrating on what the stock market is and why we invest. So the stock market is a place where you go to buy a piece of the action or promised revenue or profits. And what I mean by promised will be covered in a later slide. They're mainly publicly traded companies of all major countries in the world. They can cover all sectors and come in all sizes, and they're all for sale. What I mean by all for sale is that the stock price is a representative of a piece of the business. If you are able to buy all the stocks, you will technically own the entire company. In reality, this is very difficult to do. Stock prices are ever changing, and the more shares you buy, the more upward pressure you put on the stock price, causing it to go up, and therefore the more expensive the share becomes, until you get to the investors that don't want to sell their shares, and at that point you would have to ask them how much they would be selling for, and they would probably ask for a phenomenal price. However, all the shares are there to be traded at all times in business hours. The example that I'm going to use for this would be Coca-Cola. Its current share price is $46.60 as of the 19th of April 2016. The amount of outstanding shares is 4.33 billion shares. So currently the company is worth in total $201.7 billion, which is the formula of the share price of $46.60, the outstanding number multiplied by the outstanding number of shares, which gives you the total price of the company. Now, if you were to have $201 billion and you were to attempt to buy those shares at that price, you would probably push up the share price. So as you're buying more and more shares, the shares will become more and more expensive because of the lack of shares that you are buying, and therefore that is why it's difficult to buy a company outright, especially one that is trading on the markets. I mentioned in the earlier slide promised revenue or profits. Now, buying shares is buying part of the business or enterprise, and therefore it is buying ownership of part of that business. Promised really depends on your overall strategy. Some businesses pay dividends, and therefore you should receive a certain amount of money for every share that you hold, and other people who engage in the stock market want to make profits from the price difference. Therefore they would buy at a share at a relatively cheap price and then sell it when it increases in price. Therefore their profits would be the difference between the price that they bought it and then the price that they sold the share at. Our strategy here at LearnBigBusiness.com is to buy and hold forever. This is also known as dividend investing. There's a long-term strategy in excellent durable businesses with excellent profit margins. We want these businesses always to be paying dividends, which increase in time through increasing revenue. This ultimately goes on to increase the earnings per share, which is a ratio that is used quite a lot in the investing world. This will generate dividend revenue over the long term, which can be used to buy more shares of the same company or different company, or allows the investor money to spend as they see fit. Why do we use this strategy? We use this strategy at LearnBigBusiness.com because It's a long-term strategy. It ensures we invest our money safely, and it ensures we receive more and more money as time goes by. Time is a factor that is always lost and never gained in life. Money and time are correlated depending on how you make your money, and this is especially worse for people who are employed, because they're actually trading their time for a certain amount of money. It keeps our money generating money at a percentage that is higher than inflation, and this depends on the company and how the earnings are growing from year to year. Therefore, it ensures that we get wealthier as time goes by, and this is why we choose to invest in this strategy here at learnbigbusiness.com. When do we sell a stock? We only sell a stock if it's overvalued or overpriced by the market, and we use a ratio known as the PE ratio in the investment world, where it's the price of that share divided by the earnings. This is a totally different presentation where it's described in more detail. When this PE ratio is high, it is a sign for us to sell the stock. However, we normally only sell stocks when we have a better stock to buy, or a good company at a cheaper price, so we can move our funds across. Or, as some people like to do, you can sell the share and spend it as you like. That concludes our presentation on what the stock market is and how it works on a very basic level. Please watch our videos on basic stock market ratios and how they can be used to pick good, strong companies. There are also more videos available on our YouTube channel and on our website. Thank you for listening here at learnbigbiz.com, where we help you produce more profits through your business or your investments. Please subscribe to our YouTube channel and to our website.